Good morning, everyone. I hope you can hear me. We'll get underway shortly to have a look at what's happening in the Aussie residential property markets around the country. It's a pretty interesting time. May 2025, we've just seen a few sort of landmark events occur, so I hope everybody finds it pretty interesting. Let's first of all just make sure that we know that this is just general advice. So here's a disclaimer: it's not designed or intended to be personal financial advice of any type. General information, and if you do need any assistance, then please don't hesitate to reach out on a personal basis. So just as a little bit of background in terms of what we do and who we might be able to assist, there are various businesses. Wise Guru is our international consulting business which specialises in assisting Australian expats around the globe and also foreign residents in relation to most of the events that take place when people want to buy a property in Australia. Legal, accounting, tax, asset type, etc. We also have other businesses. We have Unicorp Partners, which is the licensed Australian financial advisory business that was founded some 37 odd years ago. We have Aussie Loan Guru, which assists both domestic clients in Australia, mainly professionals, medicos, legal, accounting, mining, etc., but also specialise in a niche market with Australian expats around the world earning foreign income, where we can assist them with a very special, unique situation, allowing them to obtain 85% of the value of an asset, of a property, as a loan without having to pay mortgage insurance to the bank. So really important issue there. And Aussie Property Guru, as the name suggests, is the Australian real estate business which helps people in Australia and elsewhere to make better informed choices in relation to purchasing properties in Australia. So that's just a little bit of background. And then for people that don't know, I mean, our clients are diverse in many ways, from medical specialists in Australia to financiers, bankers, people working for multinational corporations all around the world. But they have many attributes in common. So they're generally high income earners. They want to make better informed choices and decisions and haven't got the time to do the research themselves. They're especially time poor, and that sort of goes across the board, whether you have younger children or older children. It's pretty much a case of people are very time poor these days anyway. And most of them are wanting to add property to their asset base, so they want to buy some property in Australia and they want to build their wealth in an affordable and a tax efficient manner and end up with obviously a better outcome than if they just sort of went shot from the hip. So we have developed over time a concierge service which basically helps people to circumnavigate all the things that are required when they're looking to buy a property in Australia, and which assists them with all the various facets of that, from sourcing properties to making sure settlements go accordingly and smoothly, assisting them with finance, obviously, as I said earlier, sometimes with 85% loan to value ratio loans without having to pay mortgage insurance, which can save people thousands or tens of thousands of dollars depending on the value of that property. And most importantly, I guess it helps people save time and they get a sort of assistance along the way, a hand-holding process, which makes the whole purchase process and settlement process a lot less anxiety producing. So what are some of the most common questions that we get asked? And they've changed a little bit. A quarter ago, it was, when will the RBA cut? Well, now the Reserve Bank of Australia has just cut the official interest rate second time, their recent May 1920 meeting. And the question is, how much will they continue to cut interest rates by? Another one is, and many people are asking this, like, how are these reducing interest rates going to impact property prices, especially over the next 1 or 2 years? Third one is really a question we get asked all the time. Which areas have the best upside prospects due to immigration, so overseas immigration, and also interstate immigration, because they produce varying different outcomes for property values. Will rents continue to increase? Because we've seen strong rental growth around most of the property markets in Australia. Will that continue? And this time of year, many people are asking us the question, well, should we prepay our interest prior to June 30? And they're all good questions. I mean, that's more related to your personal financial situation, tax, etc. But all of those things are really pertinent. So we'll go and try and answer those in some detail. As we all know, Australia is a very large country. It's a continent. And so research is really super important, because what's happening on one side of the country to the other is totally different quite often at any same given moment in time. We utilise most of the national research houses to provide us data. The Australian Bureau of Statistics is a very good source of data, and they're fairly time efficient as well. But we look at CoreLogic, which is now rebranded as Cotality, Urbis, Resolution Research, and many other providers, plus the major banks. So lots of data to draw upon, and we then try and put that together, because data in its own right can quite often become really more confusing than anything else. So you need to have an overlay of how to use that, and we try and use our 3.5 decades of practical experience to help people with that. So, what's happened with interest rates? What are they going to do? Well, if you have a look there, you can see the 30-year average interest rate in Australia, official cash rate, 20-year and 10-year, vary quite a lot. And we currently, experienced one of the most rapid rises in the official cash rate over the last 3 or 4 years. And now finally we're seeing some amelioration in that. So we've had 2 rate cuts from the Reserve Bank of Australia, and I think that's going to continue for the rest of the year, and maybe even into the new year after that. Financial markets are pricing in another 2 to 3 rate cuts this year. So, the risk may be more to the downside than the upside there, because no one really knows how the international backdrop of tariffs is going to play out over the course of the next 2 or 3 quarters, and how much pressure that's going to put on the global growth and potentially unemployment. So my guess is we'll get another rate cut in potentially July, otherwise August, and I'll go through that in a bit more detail as we go through some of the data. But as you can see there, I mean, the combination of reducing rates and improving consumer sentiment are going to put upward pressure, I think, on transactions, so volumes, and potentially also housing prices. And Australia finally has joined the rest of the developed world in reducing rates, although more modestly and more slowly, I suppose, but they were also perhaps not as fast in raising rates as some of the other central banks, especially the Fed. So one thing that does happen, as on the way up, the transmission mechanism in Australia is fairly rapid, because most people are on variable rate mortgages here. So that means as interest rates go up, immediately after the next, generally 2 weeks, most of the major banks and other banks pass on those rate increases, or now decreases. And so the transmission mechanism is fairly rapid, and the impact can therefore be fairly quick, as opposed to somewhere like the US, where most mortgages are fixed for up to 30 years. So if we have a look at that, this is pretty important. If you have a look at what's happened to housing prices over the 2 years after the start of the rate cut cycle, so we've just started our rate cut cycle in Australia in February. If you have a look, the 2 smallest increases were in 1984 and in 1992, 6% and 5% over that 2-year period. However, it's interesting to note that at that time unemployment was around 10%, so that has a major impact, whereas currently Unemployment is sort of at multi-decade lows, and the interest rate cycle coming down, I think, will have a more pronounced impact than in those two particular easing cycles. So if you have a look at some of the others, 98 was a standout time where you had a 60% increase, but there were other factors involved there, deregulation, etc. So we'll obviously monitor this, and our viewers will see firsthand how this plays out over the next 18 months or so. But I think it will be a situation where you're not going to have runaway growth, and that's probably due to affordability, but I think it'll still be quite pronounced. So if you have a look there on the right, the RBA cash rate and the average term deposit rates, a couple of impacts there. One of them, obviously, banks like to make use of this to increase some margins if they can. So they'll lower the interest they're going to pay depositors. But on the flip side of that, a lot of the perhaps older cohorts in Australia, as in other developed economies that have large amounts of cash savings that are on term deposits or floating rate cash management rates, are going to find the income they're deriving from that keep being eroded. So they may also look for another home for those assets that they have in cash currently. These are the latest forecasts from Friday from Westpac in relation to what they feel is going to occur over the rest of the year. So you can see there they've penciled in a rate cut September of another 25 points. As I said, I think that may come earlier, July, August. But I think over the course of the year, as you can see, another rate cut penciled in for December. So another 2 further cuts, if you like, coming through. I think there may be 3. And that, look, is data dependent. So we'll just have to see what impacts this the tariff situation has on global growth, global trade. And also the RBA is now quite comfortable that it does seem to have inflation coming down within its target band of 2 to 3%. And unemployment is probably the next measure they're going to look at, and to make sure that that doesn't get eroded, I suppose, in a manner that isn't consistent with them trying to keep also full employment in the country. So we'll see what happens there. For our, all of our offshore Australian expat clients, the exchange rate forecast, that's also pretty important, because if you're getting paid in US dollars or Hong Kong dollars or Singapore dollars or UK sterling, the exchange rate's important. And at the moment, we're seeing a situation where a lot of our Australian expat clients have been utilising the weakness in the Australian dollar to either send money to Australia for various needs, or to look at purchasing further assets, because on a comparative basis they're getting a bit of a tailwind and a boost due to simple FX conversions. So, pardon me, we had this slide last time, but I thought I'd leave it up there because many of our viewers also ask, how can property prices keep increasing when rates are still high? And though we've had 2 cuts, rates are still high, but the situation is that many people entering the property markets, especially in the East Coast capital city markets, are now doing so with cash. So you've got a lot of wealth transfer. You've got a lot of people that may have bought a house 40 years ago. Their children have grown up and left, and they're now selling that property for a much greater amount than they paid. It's quite often 10 to 20 times what they paid at that time. So they've got excess funding, they've got cash, and they're looking to buy something that suits their needs now. They're in the reward stages of their lives, and they're looking for security, comfort, luxury, lack of maintenance, all the rest. So that buyer is not impacted by what the interest rates are. There's also assistance in terms of inheritances. There's a huge amount of money intergenerationally starting to change hands. Sometimes the bank of mum and dad can help with a deposit for people, and also a lot of you know, a lot of people, professionals in their 30s, let's say, or even younger sometimes, are looking at rent vesting. So they're going to buy a property, but they're going to buy an investment property, and they're going to pay rent to live somewhere that they choose to live. Because let's say they live in, you know, one of the major capital cities, where they want to live may not be affordable for them in terms of buying that house, but they can pay the rent and they can still enter the market and buy an investment property, which will give them some other tax benefits generally if it's the right style of asset. So that's just really what's happened there. You know, I mentioned there the downsizers, I call them right sizers, because you know, quite often there's people that sell their homes after 40 years of owning them. Generally don't want to skimp on quality. So if they're going to go into, let's say, I don't know, a different style of asset, an apartment, they want a luxury apartment, and quite often it can cost more than the house. So just some things to look at from an anecdotal basis. We also look at lending, where the lending is going to. Is it going to first home buyers, going to investors? And as you can see there, I mean, there's been a bit of an increase here. If you look at 10-year averages, you can see that Western Australia, Northern Territory, South Australia, to a lesser extent Queensland, there's been an increase to investor lending in those markets, and some of that obviously had to do with affordability and I guess more bang for your buck. But we're seeing first home buyers still very active in the market, and so overall, if you look at the national situation, investor lending is around 37% of current debt levels, and it's probably been rising, as we can see in that graph, over the last 4 years. So coming back to those commonly asked questions, and they're really, it's a great question. I mean, you know, where are people immigrating into Australia from overseas? Where are they moving in within the country? Because those things really impact housing availability and therefore pricing. So if we have a look at the latest ABS data, in the September quarter, which is the latest quarter, net overseas migration was 89,800 people, an increase of 30,000 over the previous quarter. That's interesting, you've got that uptick. And Australia's population was, 27.3 million, so it's growing, and it grew by 484,000 people over the last year, so a 1.8% increase. They're pretty big numbers for a large country with a small population like Australia. And that population growth from overseas migration has peaked, but there's still really large numbers in nominal sense. If you look at 1.8% rate of increase in population growth for any developed nation, that's really high. So I think we'll continue potentially to see some decrease in that rate of increase, but some of that will depend on politics, although it doesn't seem to be having a lot of impact in the real world at the moment. If we have a look at what's projected and forecast, I suppose, to happen, and as you can see from some of these graphs, it doesn't exactly play out, because again, the latest September data has seen a continuation of the existing trends, and there's quite a lot of dispersion. And in fact, it's not Victoria that's had the highest rate of increase. It was Western Australia, growing by over 2.5%, followed by Victoria at 2.1% and Queensland at 2%. So these things, forecasts as always are great, but you've got to look at the data when it comes in and see how that compares. I think the important thing to note there is, rate of growth is still pretty strong in most of those markets. One of the other things that one needs to look at is the stability of the banking system, I suppose, and so the quality of housing credit, and there was talk about risky loans, etc. I don't really like that terminology, but what people are referring to is high debt to income levels, high loan to income ratios, high percentages of interest only loans, and high LVRs or loan to value ratios. But as we can see, most of that really is well and truly very conservative. We've seen an uptick in the amount of loans that are interest only, and I think there's two reasons for that. One, we've seen an increase in investor loans, so it makes sense to have those on an interest-only basis for most people who especially are paying tax at the top marginal tax rate, to make use of all the tax advantages. But also, because rates have been very high, consumers, borrowers have been looking at converting some principal and interest loans to interest only to enable them to meet their obligations and pay those mortgage payments. All right, well, let's look at property as an asset class, and it's pretty telling to look at this. I mean, residential real estate in Australia is worth $11.3 trillion, and if you have a look at the ASX listed stock market is 3.2 million. Our retirement savings, our superannuation pool, is one of the top handful in the world. As you can see, that's 4.2 trillion. So some pretty large numbers there when you compare it to, say, commercial real estate at 1.3. And the other thing that's really important, I tell people all the time, is have a look at the outstanding debt against that 11.3 trillion. It's only 2.4 trillion. So at the end of the day, the amount of leverage out there in Australia in the residential real estate asset class is not high. So what's happened to prices over the last 12 months? Well, as you can see there, in the quarter they were up 1.1%, over the year 3.2%, so that's come down quite a long way from the heydays post-COVID, thankfully, to allow some people to enter the market. And the other thing that's quite noticeable is there's been quite a change between the rate of increase between capital city markets and residential markets, and I think that again is now sort of played out a lot due to affordability. So with high interest rates, especially in the lower quarter, on the cheaper part of property markets, it's played out that people are looking to get a bit more bang for their buck, so they're prepared to go to regions where they have to pay less to obtain more, as opposed to before. If you look at the 3 monthly change, it's positive everywhere except regional Northern Territory. So, and again, it's probably a bit more uniform apart from Darwin and regional South Australia, WA and Queensland. But if you can see what's happening there, the combined capitals and the regionals have grown more strongly, but capital markets are now bouncing back, and as you'll see in a minute, that's due to certain segments of the markets there. If you have a look at that, and viewers who watched have seen the last quarterly review will recall that the upper quartile in both Sydney and Melbourne was amongst the poorest performers, going down over the prior 3 months. And if we look at it now, as we can see, Sydney and Melbourne, they're some of the stronger performers and certainly have shown the greatest turnaround. So it's interesting to see that potentially the easing cycle, what impact that's had on consumer sentiment, has played out more in the upper quartile of those capital city markets rather than the lower quartile. If we then look at supply and demand, and we always do because this is such an important issue, as we all know, everything about things that are traded on the market, assets are really impacted by supply and demand. And as we can see there, supply, or dwelling approvals I should say, have trended higher. They don't always translate into supply, however, because a lot of the dwellings that are approved, especially the apartment market, don't actually materialise. So it's something to look at. But in relation to the overall situation from a macro level, the government said they're going to produce 1.2 million new homes over 5 years. Well, as I've said before, I think that's just not going to happen. And as we go into it, the data is showing us that it's not happening. So dwelling approvals are 15,900 as opposed to 20,000. Yeah, that's just going to get harder and harder to meet that target each quarter that goes by. But we'll have a look at it. And it's a situation that's going to exacerbate the current position where there is insufficient supply to meet the demand, and that will again obviously potentially put some upward pressure on current housing values, especially in markets that are already suffering from lack of stock. So look, important, this is a question that we get asked quite a lot because of our various expertise in various businesses where we look at assisting people with their wealth management, I suppose, and that includes all sorts of asset classes. But there's a common question about, should I be buying shares or should I be buying property? And of course the answer is, you should be buying both. But in terms of what's better, look, I don't think it's a very important situation to look at, because I think if you buy good quality assets, whether they be shares in companies or bricks and mortar assets, you're going to have a much better outcome than the average. And if you look at the numbers here, you can see that both property and shares, they're both growth assets, they're growth asset class, produce a fairly similar outcome over the longer period of time. In this instance here, in Australia, a residential property over 10 years has produced more than the stock market. But if you look at over 20 years or different time periods, that can vary. I think the most important thing to look at here is the level of volatility. So as we all know, you look at Bloomberg or CommSec in Australia, and you look at share prices and they vary daily, by the minute, whereas housing prices tend not to be valued on a mark-to-market basis. So the amount of volatility in each asset class is quite different, and that in its own right is not as important as the outcome, because some people may say, well, look, this is my long-term investment plan, I don't care about the volatility. In reality, we find that most people do, and so if something happens in markets, the recent Liberation Day announcement by Donald Trump was a classic example, which caused equity markets around the world to cave in, and a lot of people were worried, and I can understand that, especially people perhaps who are nearing a retirement or have just entered retirement, because it is, from their viewpoint, quite important. But that's where you really have to look at how comfortable are you with trying to get a higher return and coping with the volatility of that. Whereas, in property, most people use leverage, and they use that quite conservatively or intelligently. And if you use the same amount of leverage, let's say 80%, with a portfolio of stocks that was supported by its share portfolio, you could be in real trouble. Because if the value of those stocks drop 20%, as happened not that long, a few weeks ago, your equity could be totally wiped out and your whole asset sold up. That doesn't happen with property, as long as you keep making your mortgage repayments to the bank. So that's a really important thing, I think, to take home from that. If we look at the rental market, most of our viewers around the world who own property in Australia have seen some pretty strong rental growth over that time. And whilst that's now trending lower, it's still growing. And I think, certainly a lot of our clients who have property assets saying, well, is that going to continue to increase? And I think the short answer is it probably is. And here we've got, higher for longer rates means higher for longer rents. The interesting thing is rents aren't quite as elastic as interest rates. So, with a couple of interest rate cuts, we haven't seen any of our clients reduce their reduce their rental rates. So, it's hard, I think, for people who are looking to rent new properties, because there is a massive lack of supply, and they're still having to pay top dollar, as it were. So the annual pace of rental growth has eased, But if you have a look at it realistically, you still have rental growth of, Perth is certainly a bit of a standout in Adelaide, but on the flip side of that, even Sydney at 2%, Melbourne 2%, still important and still, I guess, tracking closer to the lower end of CPI level. And we find over the long period of time that rents tend to increase at least by CPI. So you can see there that trend has come off, but it's still a reasonably significant number when you look at 3.6%. And clearly that rate has changed from the larger capitals to the smaller capitals, showing a greater rate of increase. So if we look at rental yields, they've remained surprisingly steady, as you can look at there over the last 3 years. 3.73%. It's still a relatively high number over the longer term, and it's certainly been a substantial rise after the sort of pre-pandemic or pandemic lows. And most people look at that and say, where is the difference? Because that's a generic amalgam of rents from various markets. And if you can see there, Darwin or Sydney, there's a fairly big difference from 6.5% to basically 3%. So that's made up of, then again, within those markets, various assets, whether they be apartments, which generally have a higher yield, or houses which have a lower yield, etc. But it's important, I think, if you're looking to purchase a property, to do your cash flows and just see that you're not being too much of a risk taker, perhaps, and relying solely on potential capital gains and forgetting that you need income to service the ownership of that asset. So how do we use all the data? How do we use all the research? Because there is so much of it around. I think it's important to recognise, because people, especially overseas, always say to me, what's happening in the Aussie property market? Well, there is no such thing. It's just too diverse. The property market in Perth or Darwin, Sydney or Hobart are so different. So, what else do you look at? And I think it's important to have a look at a number of other things, but this is not a bad one. The amount of stock that's on the market or coming to market. So most regions have seen a drop in the flow of fresh listings relative to a year ago, which is interesting. And some of that's due to seasonal factors. In April we had 2 long weekends, etc. But it really, you can see from those numbers that there is a substantial decrease there in the number of listings that are coming to the market or being on the market. So people have less choice in relation to buying a new home or buying a new investment property. And that again, I think, is reflective of this supply-demand imbalance, where there is insufficient supply in most of the markets. And it's exacerbated in some of those high growth markets, but it's also quite evident if you look at Sydney, Adelaide, Brisbane, Melbourne, etc., in those markets. And the other thing to look at, I think COVID brought about a profound change in people's preferences for homes, where they were going to live. So they wanted larger dwellings. They'd like a multi-purpose room quite often that they can use as their home office. And during COVID, you had that sort of rush of people going to the regions, escaping the cities. Well, that's come back to people coming back to capital city markets, and the ones that are going to the regions now, I think, doing so just for affordability reasons. Now, this is, I think it's an important one, because a lot of people say to us, well, my God, what's happening to property prices in Sydney is just ridiculous. I hear that quite often. The amount they've gone up is just crazy. And you hear it a lot from the Aussie expats who have been out of the country for many years, because they're probably not as attuned to what's going on within, the city they may have come from 10 or 15 years ago to now. And far from being crazy, it's just reality. So you've got to look at things perhaps in a slightly broader time frame. That's what I'm trying to do here. So, is the growth we've seen over 5 years, last 5 years, unprecedented? And And as you can see, it certainly isn't. In fact, if you look at the situation that happened in the late 80s to 89, you saw in that 5-year period an increase of nearly 80%. So the 39% increase over the last 5 years pales into insignificance over that. But there were a number of times when growth was higher. So I think people need to take that into consideration. And while certain markets will reach those highs at different times, and they'll continue in the future, depending on underlying economic conditions, interstate migration, sometimes overseas migration. But that's why it's so important to do this research, to look at what's going to happen over the next 5 years, or 10 or 15. So because property is, generally speaking, a long-term investment, not a speculative buy. And if you have a look at what's happened in, say Perth has shown a sensational increase, but then it makes up for a decade of lost time. And that happens in various markets at different times. So if we look at this, it's a pretty good example. You look at the change in dwelling values from the peak. Sydney's down 1.1%, and that was reached in September 24. But over the past 5 years, it's gone up 29.7, nearly 30%, and a bit over 60% over the last 10 years. And then you look at somewhere like Melbourne, the last 10 years, 43.8%, Brisbane, 91.2, Adelaide, 93.6. So, I think people sometimes forget about these things, and they have their own preconceived ideas in their minds, which quite often can be far from the actual, factual truth, as it were. So really important to look at this, and then also I think delve into what is the sort of house, unit, townhouse, asset style that's going to be in greatest demand and shortest supply over the next 5, 10, 15 years. So, as we often say to people, it's all as easy as pie, and it has nothing to do with pies, but it's about population growth, infrastructure growth, and employment growth. And if you have those 3 key metrics around where you're going to buy a quality housing asset, you should end up with a pretty good outcome. So let's have a look at the various markets, and as we know, New South Wales, most of our viewers know, New South Wales has the most diversified economy. Sydney's still, I guess, the most expensive and preeminent property market in Australia. And it does have still the highest downside risks due to affordability, but I think with interest rates coming down, that's going to be ameliorated, and this ongoing demand for quality within Sydney seems to be ongoing, as it suggests. So quarterly house prices has actually kicked up in the last quarter, but overall it's been slowing down over the last 12 months, and overseas immigration demand is the strongest of the market. So if you have a look at that, in April, so the monthly dwelling values 0.2%, so pretty line ball, up 1% over the quarter, and over the last year just under 1%. So you can see that's really slowed up, but kicked up in the last quarter. If you look at Melbourne, that again has seen a great rise in overseas immigration, so population growth there. But a lot of that, I think, has been overseas students, because they do such a good job of marketing their tertiary education institutions in Melbourne in particular. So it's a situation where those people are looking to rent. They're looking to rent somewhere then to buy, and so it'll have an impact on different areas of the market, or of that property market, and more so on rental markets than on purchasing markets. So if you look at that over the month, again, pretty much line ball. Melbourne's probably been the underperformer of the capital city markets. It's down 2.2% over the last 12 months, and it's up 1% over the quarter. So I think, possibility there we could see some rebound, albeit perhaps modestly. So if we then look at Perth, as we mentioned earlier, it's had the strongest annual capital city price growth, population growth, rental growth, but now, there is that slowing affordability as Perth has really made up, as I say, for that lost decade of time, and now starting to reach areas where people again are struggling a little with affordability. So if you look at that, have a look, for the month up 0.4%, 0.7 for the quarter. So you can see near term how that's slowing up at up 10% over the last 12 months. And this is a pretty good indication of what's happening in various markets. So it's CoreLogic's hedonic home value index. So if we look at May, look at the various cities and look at the median values. So Sydney, as always, is generally the highest median value in these markets, but the monthly growth has been slowed up, if you like. And if you look now, the quarterly growth between Sydney, Melbourne and Brisbane, and virtually Adelaide too, is almost the same. Pardon me. Annual growth obviously quite different, 0.9% in Sydney, minus 2.2 in Melbourne, plus 7.8 in Brisbane and plus 9.8, 10 in Adelaide and Perth. So quite a different story, and that's why again I think all these numbers play out and show people that research is really important, and unless you have the time to do it and the expertise to do it, you're well advised to take somebody in to help you with that. This is a question we get again very often. Should I buy something new or should I buy something old? And again, there's no right or wrong answer for this. I think it just depends on your own circumstances. So if you're perhaps skilled in construction or have some experience in that, or you have access to extra time, you might be looking at retiring, etc., or you have expertise in development, then where you get an old property that you can add value to from doing these things, that's often a very sensible approach. For most of our clients, it's probably the reverse, because as I said, they are very time poor. They don't want to get involved in the hands-on situation of managing their property assets. So they want something that's light touch. They don't have to worry about repairs and maintenance. They want tenants to be there long term and not cause them any sort of grief at all. And that's easy to manage. So they'll tend to look at purchasing new properties that have those attributes. The other things, I suppose, that we consider too is because a lot of our clients are, as I said, high income earners, so they're paying the maximum tax rate, is the benefits of Division 40 and Division 43 depreciation deductions or allowances, so tax deductions, which you can offset against either personally derived income if you're an Australian tax resident, or other income from other sources. So that's pretty important and fairly unique to Australia, but certainly a benefit if utilised correctly. So, the data's been telling us this for a period of years in terms of where we think investors can focus and obtain a good result, not just for the short term, but for the longer term, which ties in with what they're trying to do with property as being part of their overall asset mix. So that's been Southeast Queensland, Brisbane and Southeast Queensland. There's still a very substantial gap to Sydney. The median price in Brisbane has moved up to be second behind Sydney now. So that's quite different, where Melbourne was always, if you like, the second most expensive capital in Australia. That's changed. And the situation here, and I think the Australian federal election we've just had showed that up, I suppose. The work from home lifestyle factors are still enhancing growth in Brisbane, and it's really interesting to see where the coalition was doing a sort of Trump-like situation where they're going to get public servants to go back and work from the office. And I think the voter backlash at all of that is pretty good evidence that people still favour a hybrid, at least, work from home lifestyle situation. And I don't see that going away. So I think it would be prudent to look at that and see what sort of impact choosing the right property can have over the next 10 years or so, where people say, no, look, I still want to work from home as well as the office. And quite often they look at other things, climate, clearly infrastructure and entertainment availability around wherever the property is, etc. So Queensland has a well diversified economy. As we can see there, the rate of monthly increase was actually greater than most of the other capitals. Quarterly increase similar to Sydney, Melbourne, and over last year the values have increased by 7.8%. But I think this is probably a really important issue to consider, and that's where's the population growth coming from? And if you have a look at this interstate migration, look at this, minus 29,000 in New South Wales, plus 28,000 in Queensland, and they're the standout numbers there if you look at that. Now, all those people that move interstate generally are moving into a new employment role. They're going to have their kids in new schools, and they're looking to purchase something. If you look down the bottom here, net overseas migration, 120,000 in New South Wales, 64,000 in Queensland. Well, those people are going to be looking for something to rent. So, I think they're the things that you've got to look at. And this has been going on for many quarters, as most of our viewers will recognise. I follow these numbers very closely. But then if you look at Victoria, that's had, a growth rate of population slightly above that of Queensland, 882 people moved in from interstate, 112,000 moved in from overseas. So, I think if you start focusing on these things, you'll get a much better outcome if you're going to become a property investor. That's just graphically showing what happened in the latest data there. New South Wales and Victoria showed the largest population increase due to net overseas migration, as usual. And Queensland's continued to see the largest net addition to the population due to interstate migration, which is, as we can see, probably mostly come from New South Wales. So, keep an eye on that. These are really important data sets. This is what's projected up until 2034, and Brisbane's population is projected to be 3.2 million then, and population is projected to overtake the population of the rest of Queensland in 27-28. So the other thing to look at, I suppose, and we'll come to that shortly, is what impact the 32 Olympics might have, and see where that potentially could assist new purchases in making above average returns. So if we have a look at this, the shortfall, we're looking there at apartments within 5 kilometres of CBD, has never been as great as it is now. So new supply coming to the market is massively constrained and very difficult to kickstart, because the costs of building new dwellings is making it unfeasible for builders, for developers to start new projects. So this shortage is going to continue to grow, and most of these types of buildings take 3 years or so to construct or to get approved and constructed. So it's going to get much worse, I think, before it gets any better. And that's something that's then really helpful, I suppose, for somebody looking to enter the market and say, well, what type of asset is going to be in greatest demand? What should I be looking for? So the other thing, as I said, is the Olympics. Now, clearly that's going to have a massive impact on the provision of infrastructure. A lot of that has already been begun, and some of it is starting to get completed, but there is yet a lot more that is only just about to be begun, starting, and that's going to create more employment in the interim, but then far greater efficiencies in terms of especially traffic and roadways, undercity rail, lots of infrastructure that's going to help improve the efficiency, I suppose, especially of Queensland, Gold Coast, etc. So you've got to look at that, and I think a lot of people are, and say that's going to be a pretty substantial tailwind for the next 7 or 8 years. There's a lot of development that's having completed, like extra runway in Brisbane, Cross River Rails, going to a lot of things that are happening. And let's have a look at what's the value proposition as we see it in terms of what we can provide to our clients around the world and within Australia. And that's really to help people making a lot of common mistakes. So as I said, people tend to buy into a strong market. Now, whether that be in property or in equities, people often charge into something when it's very, very buoyant, when it's very high. So we like to tell people to buy into a market that's a strong market of the future, or that has the potential to be a strong market for a long period of time rather than now. There is no lack of information out there, research. It's just that people don't have the time to access it, and quite often if you do, there is so much that can become contradictory or very confusing for people. So that's another issue that we see quite often. And a lot of people then wait too long to invest, and they keep waiting and then sort of say, oh God, I should have done this years ago. But that's when they'll go, oh, I just need to buy something. Well, any investment won't do, and that's what I'm saying. It's so important for people to actually think about what it is that certain demographics within the country are going to be looking for and wanting over the next 5, 10, 15, 20 years. And then ignoring your point of difference. That's also really important. So if you want to buy something, buy an asset that has some unique properties, that differentiate yours from everyone else's. And this is where, you come into this. Now, whether it's, an investor-style unit in a massive tower in Melbourne, or in Surfers Paradise, or a one economy town like, say, Port Hedland in northwestern Australia, which relies mainly on iron ore. Be careful of those sort of things, because if you've got 400 little one-bedroom apartments in a building, they're all the same, and you're looking to rent it or sell it in the future, what are your unique attributes? What's going to help you obtain a better price? If you've got a penthouse, let's say, in a tower, and there are only 2 of them, I'd rather have that, I suppose, than the other. So lots of things to think about, but we try and help people tie that together. So strong economic activity, not just now, but for the long-term future. Infrastructure growth, like I was talking about, employment growth, future sustainability of that, and the unique attributes of your property. So if you put all that together, you'll end up with a very good outcome. So look, what are we looking at this year? Because as I said, it's very hard to get things like this because of the lack of new supply. So please have a look at this as really I guess more of an indication of certain styles, I suppose, the best way to talk about it, in terms of type of property that you might want to look for. As I said, a lot of people with the money that don't require a loan, reward stages of their lives, are looking to reward themselves to get the style of property that they've always wanted, I suppose, and couldn't manage when they had kids going to school, etc. So, and there's just so few of those. That's the other thing. I mean, a lot of our Australian expat clients recognise this because they live in different countries where this has been commonplace for decades. People in New York or London or Paris or many other cities look for these sort of dwellings and cherish them, and they're highly prized. It's just in the Australian market, which has had different levels, I suppose, of sophistication that hasn't even been available, so people don't recognise that. But certainly that's an area where there is not going to be an oversupply. And I think, new supply is going to be constrained, whereas the amount of people that want that and can afford that is going to continue to grow. Another thing we do is look at things in different stages, so from planning to completion, and clearly we only choose a very few of the things that we see in the market because we believe they could be suitable for our clients, and a lot of them are not. So have a look at this. I'm here in Brisbane, Queensland. We're in the suburb of Windsor, and behind me is a new site that's being built named Sayre. This is approximately 4 kilometres from the CBD, in close proximity to Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to in Fortitude Valley, which are clearly not far removed. And it's interesting to note that the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after when sites are getting built to give us a far better understanding of what our clients are going to see when they receive their finished product. Right, so now looking at some of the commercial aspects of this, and this is generically correct, so over any given cycle, who pays for that property? And this is where I'd say the choice of the property you're going to buy is really important, because this relates to a new property that has high quality finishes and inclusions, and therefore very high Division 40 and Division 43 appreciation allowances. So if you're an Australian tax resident, you're a surgeon or a lawyer or barrister or accountant, whatever in Australia, it's pretty attractive because the tax office actually is a very significant contributor to the income that's used to purchase that asset and pay for it. If you're a non-resident, so if you're an Australian expat, then you're going to have to save up, generally speaking, those tax credits, unless you have a substantial amount of other taxable Australian income, such as rents coming from your property portfolio that you already own. But generally speaking, you'll have to wait and utilise those tax credits either when you sell a property and offset it against the capital gains tax that you need to pay, or if you at some point in time return to Australia and start earning money in Australia again, you can offset it against your personal exertion income. But it's a reasonable difference. So if you look at this situation here where we look at these property investment analysis reports, buying this property is from a cash flow viewpoint going to cost someone $380 odd a week, whereas if they're an Australian tax resident, it's not going to cost them anything cash flow wise after tax. In fact, they're going to be $12 better off. So it's not that the expat loses that extra $380 odd a week. They're just going to have to wait to utilise it at a later point in time. But the person that buys an old property that doesn't have any depreciation items certainly is missing out on a lot of potential gain that they could get out of choosing the right asset. So if you look at that, if you can see what happens over a period of time, who pays for what. Your tenant's going to generally pay the largest portion of that outgoing, but the tax, if you like, the tax allowances or the depreciation allowances are very important and will give you a much better outcome over time. So I think the best way to describe that is, I remember a client who looked at 2 properties and they bought one new one with around a 5% yield in terms of the rent they were obtaining, gross rental yield, and they bought another old property, a small cottage, on a larger block, and the yield on that was really about 1.4% growth. So both have different attributes, and both will potentially, if they're in the right areas, produce a good outcome, but you've got to be able to hold those assets over that period of time. So if you're obtaining a very small income on something, as in the old house, then the capital gain should compensate you over time, but you've got to be able to fund that. And if you can't, as happened in this instance, you have to sell that property quite often at an inopportune time, and thereby that will not then give you the returns that you should have enjoyed if you kept it for the longer period of the investment horizon. So important to think about those things from a real life situation rather than just saying, they're numbers, etc. So if you have a look at this, and as we say, property investment is investment, it's not speculation. And all you have to do, if you buy the right quality asset in the right location, it's as easy as pie with all of those things around it. All you have to do is keep it. As you can see here, over time, the value of that asset generally continues to grow at an accelerating pace. Most people tend to sell their properties after 4 to 8 years, and they're missing out clearly on much of the capital gain that they would otherwise be able to obtain simply by keeping those assets. So making the right decisions up front, very important, and also not being lured into speculation. Now, you might buy a property at the right point in time in the right location of a type and enjoy a substantial gain in the first 12 months. And this happened to some clients of ours, and they say, I'm going to sell that. Well, it's probably important to consider the tax impact of that. If it's less than 12 months, they're not going to get any capital gains tax discount as an Australian resident. And then say, well, what am I going to do with that money? Because I'm going to have to pay a substantial amount away in tax, potentially for no reason. Because if you keep it over the longer term, you might just build up a whole lot of equity, and if you want to use that to purchase more assets, you can potentially, depending on the rest of your financial position. But these are the things that are really important. I think, as I said, our decades of experience can help people circumnavigate the situation, hopefully with a good outcome for their own personal situation. So what's the solution? Well, I think we can assist with helping to find people a solution. As I said, we've had over 3.5 decades of experience. We can give people a higher lending capacity than they would obtain otherwise, especially if they're an Australian expat, non-resident, and assist them with that whole process where they can partake of our concierge service if they so choose, or simply have assistance in perhaps lending or property selection, or one of the other areas that we can assist with. So we tend to look at people's situation from their own viewpoint, and you can book in, request a Zoom or a call in relation to looking at how we might be able to help you with an initial consultation, and we'll then certainly find out whether we can help you, and it's very transparent, let you know whether we can help you or not, and if we can, how so, and what that would look like for you from a commercial viewpoint. So please contact us. You can reach out, and we can then see if we can book in a time to look at your own personal situation and go from there in relation to giving you some assistance if that's possible. So look forward to seeing you at our next quarterly review. If anyone has any questions in relation to their own situation that this review has triggered, please don't hesitate to reach out. Email us or call us, and we'll have somebody contact you. And you'll also be sent a review if you'd like to complete that. It'll help us to, tailor these in a different manner to assist everyone across the globe in future quarterly review sessions. Hope you've enjoyed all the data and the information. All the very best to you. I'm Andrew Unterweger.